Hello, everyone, and welcome to the seventh session of the first day of the Modern Investor Summit. First of all, apologies for the slight delay. We had a slight technical issue, but it's all been resolved now. We really appreciate your patience, and we are all good to go. So I'm Ruffer, Global Markets Analyst here at Finimize, and I'm joined today by two very special guests. First, we have Duncan McInnes, Investment Director at Ruffer, and then we have Janet Mui, Head of Market Analysis at RBC Brewin Dolphin. Janet, Duncan, how are you both doing today?
Great.
Very good,
Thanks
thank
for
you.
having
I
us.
have to confess that I was the technology issue. Lucky I'm not a tech investor.
It's okay. I was not going to mention that, Duncan, until later, but you put your cards out on the table. So just some housekeeping before we get started. So first of all, actually, I want to give a massive thank you to our summit session partner, Ruffer. So Ruffer's aim is to deliver consistent, positive returns no matter what happens in financial markets. And they seek to achieve this by maintaining an offsetting balance of growth and protective assets within their portfolios. This has led to a strong track record of protecting and growing the value of their clients' investments. Their approach, for example, has been successful through periods of great market fragility, such as the bursting of the dot-com bubble in 2000, the credit crisis in 2008, and during COVID-19, which, if you don't remember, was in 2019. Now, second of all, if you haven't already, please introduce yourself in the chat, say hello, where you're tuning in from. Everyone make this as social as possible. And then third of all, just in terms of how this session is going to work, very similar to the sessions you've been listening to throughout the day, it's going to be a 20-minute discussion with our guests, followed by 10 minutes of audience Q&A, which takes me to my final point. Please don't forget to ask your questions in the Q&A box below, address the questions to our guests, and I'm sure they'll be more than happy to answer them at the end of the session. So let's kick off. And first of all, I want to kind of pick each of your brains and kind of figure out and see how you guys think about and approach investing at your respective firms. So Duncan, perhaps we can start off with you.
Thanks, Fred. Well, you sort of gave me an introduction. You should come and work in sales at Ruffer. The way that I think about what we do here, which is that sort of building an all-weather portfolio. There's 300 people in the firm. We're sort of headquartered in London, although I'm based in Edinburgh, sitting in London today. But we all do one thing, and that's sort of that absolute return approach you mentioned. I think our job is to make an assessment of the macroeconomic landscape, make an assessment of the risks that we see, the geopolitical risks that we see, what is priced into the market in terms of various different asset prices, and then decide how much risk to take with our clients' money. And that's quite different to what most of the industry does, which is more of a sort of relative return approach, where they're trying to beat a specific benchmark. We start with a blank sheet of paper, go anywhere in the world and try to find interesting assets to build out our portfolio, being cognizant of those risks and opportunities that we've tried to identify.
Amazing. And Janet?
Yes, hello everyone. So I'm from RBC Brewin Dolphin. We're one of the largest wealth managers in the UK. So in terms of our asset allocation approach, we are a top-down investor. So I'm part of the asset allocation committee that selects an optimal blend of investments to generate long-term returns for a range of risk profiles for our clients. So tactically, we take advantage of the shifting market conditions. So it's a very top-down approach. And once we have the investment strategy, we have a research team which have deep expertise to pick the right investment, including funds and also individual equities. And our clients are assured through a robust risk management process and regular review. So that's basically our investment process.
Okay, amazing. And I see some kind of similarities there with kind of taking this top-down sort of macro kind of approach. And related to that, something very topical these days, especially over the past kind of year and a half, is inflation. And kind of wanted to also pick your brains over here in terms of how you see inflation impacting different asset classes, but perhaps more importantly, how does inflation impact your asset allocation at your firms? And Janet, perhaps we can start off with you.
Yes, obviously inflation has been front and center over the past couple of years. And I think I think for the longer term aspect, we do think inflation it may stay structurally a little bit higher in the long term. So that affects how I'm thinking in terms of asset allocation and where we want exposure to different asset classes. So the reason why we think potentially inflation, I mean, structurally could be a bit higher than the past decade is we had the energy transition going on. That could be a bit more volatility in the energy prices in that process, deglobalization, and also more power of the workers. So we are seeing very strong wage growth. We are seeing labor shortages that could continue. So I think in terms of thinking about portfolios, you do want to hedge against all these inflation risks. So typically you can get exposure by inflation-linked bonds, and also commodities is a very important play as well. And we still favor energy stocks as a hedge against inflation.
That makes sense. And Duncan?
Yeah, so I think what matters from an investor perspective is what does inflation do to different asset classes? And we think inflation is back, but we have to confess we worried about inflation for quite a long time before it actually returned. But what we see coming in the next decade is inflation volatility, and it's quite important, I think, to make that distinction because if you look at the last couple of years, we had inflation that constantly surprised to the upside, and you look at the last years or so, and inflation is constantly surprising to the downside. The disinflation that we're experiencing now is just as violent. And we think over the coming decade, you'll see more economic growth volatility, more inflation volatility, and therefore market volatility. So what does that mean? I think it means that you have to consider some of those asset classes that Janet mentioned, inflation-linked bonds, commodities and so on. But actually the really key thing to think about is that the correlations in your portfolio might change. Now that can sound quite technical and wonky, but the way that assets relate to each other isn't static. It's dependent on what type of inflation regime you're in. And that was the great lesson from sort of 2022. When inflation was very high, we found out that a lot of asset correlations changed and people's portfolios weren't as diversified as they thought they were. They had this sort of illusion of diversification. And in fact, everything sort of fell in unison. So we think in the future, you're going to have to be much more thoughtful and tactical in the way that you sort of make those assumptions and move your portfolio. But I think the broad thrust of what Janet said in terms of the things that you will be picking from is probably similar.
And maybe just a quick follow-up on that, Duncan. If if during times when inflation is spiking and you've got these scares and sell-offs in markets and kind of correlations are all going to one, said simply, asset classes are all falling in unison.
Yeah.
How do you kind of offset that in the portfolio? Do you suddenly have to consider shorting certain asset classes to kind of get proper diversification, or what do you do in that scenario?
Yeah, I think that's a good question. So I'm trying not to stray into too much jargon here, but you're absolutely right that in a time where correlations are high and all assets sort of are falling in unison, like in 2022, what you really needed was something that was negatively correlated and something that would go up when interest rates went up. And there's very few conventional assets that offer those characteristics. So what we do at Ruffer, which is quite different to a lot of other managers out there, we use something, a small part of our portfolio that we call our unconventional protective toolkit. And basically, this is derivatives. Derivatives is a scary word, but a small bit of your portfolio that can punch very hard under certain circumstances becomes essential. And that's effectively, without tooting our own trumpet, that's how we managed to make money in COVID, and that's how we made money in 2022, 2 years where conventional assets and conventional markets struggled. We had these small derivative investments that went up a long way. If you want those sorts of hedges against bad events, I think derivative land is unfortunately where you have to look, and that can be quite complex. It does become less necessary as interest rates go up, because sometimes bonds can fulfill that role for you too.
Okay, fascinating and great to hear. In terms of other worries, and as investors, we should be wariers, right? And think about downside risks. Another thing, obviously, driving a big macro narrative, and investors are worried about these days, is the possibility of a recession. Also wanted to kind of get your thoughts on that. Do you think, let's say the US economy, or more broadly, the global economy, is headed towards a recession, or are we going to achieve that magical sort of soft landing that everyone is kind of hoping for? And Janet, we can start off with you.
Yes, I do think that the data-wise is actually moving more and more towards a soft landing scenario. We do edge up the probability of that scenario happening in our outlook. But having said that, I don't think the recession risk is going away, because I think there are several indicators that is flashing recession risk. Typically, the bond market, the shape of the yield curve already told you that, the extreme inversion of that. And also some credit indicators, for example, the credit availability in the US, the small business survey, how difficult it is to get credit. Those are actually flashing recession signals if you look back at the historical context. So currently, the U.S. consumers are powering the economic activity, but they may be exhausted at some point as the savings get eroded and as the job market gradually slows. So I don't think the recession risk is gone yet, but I do hope it is a glass half full kind of outlook for next year.
Okay, and Duncan, do you share in the optimism?
Well, I think it's good. That's something that Janet and I can disagree on. I think. I mean, I totally accept your points. I think we would put a higher probability on a recession, and that's really because I would start with saying we've had 5% interest rate hikes. We've gone from 0 to 5% in what in the jargon would be the sort of most aggressive tightening cycle in a generation. We had 40-year highs on realized inflation. So we've had these crazy, strong forces buffeting the economy, which is highly leveraged, highly financialized, as we know. And it just takes a little while for the consequences, the effects of these things, as the famous economist Milton Friedman called them, the long and variable lags of monetary policy, to truly be felt by the economy. Fed and the Bank of England would tell you it's sort of 12 to 18 months for the full effect of the interest rate hikes to be felt. The last interest rate hike was only 6 months ago, 5 months ago. So as Janet said, there's a lot of data that is flashing red, things that have been highly predictive of previous recessions. The yield curve inversion, Janet mentioned, leading indicators, things that look forwards to the future state of the economy have been declining for, I think, 16 or 17 months consecutively. Corporate bankruptcies and delinquencies are rising. So the signs are definitely there if you want to see them. I would sort of cynically say that it's in everyone's interest in the industry, or most people's interests, to not see them. It was like the famous Upton Sinclair quote, it's hard to get a man to understand something if his salary depends on him not understanding it. So I think like if we are in recession in 6 months' time or 9 months' time, it will be impossible for people to say that the writing wasn't on the wall. But these things are really hard. It's really, really hard to predict a recession. The key, as I sort of said earlier, is to decide whether you think there's going to be a recession, and then see if that risk, and let's say in our opinion it's a 60, 70% probability, is that risk priced into asset markets? And our view would be that it isn't, and that's the problem. Because if you think about March 2009, the aftermath of the financial crisis, the absolute market low, the economic news was dreadful. The economy was in a horrible recession, but asset prices were really cheap. So all of the risks that you could imagine and more were factored into asset prices. Today, it sort of looks to me like the market thinks Janet's right, and we're going to have this sort of soft landing or immaculate disinflation, is a Ray Dalio phrase, I think, that describes it, and we just think, well, that probably isn't our base case. It might happen, but even if it does happen, you might not make money.
And that's really interesting, and perhaps a really quick kind of follow-up on that, Duncan, is let's say you're right, and in 6 months' time there is a recession. What asset class, in your opinion, would offer the best hedge in that scenario?
Yeah, so if we'd had this conversation a month ago, there was absolutely no doubt in our mind, that the answer was bonds. So bond yields got to 5% a month ago. We were buying some on the day. It was only there for a day. We were buying some on that day, and I think that the usual response to a recession is to cut interest rates. That's somewhat inflation context dependent, but basically a recession will mean interest rates cut, which mean bonds go up. Bonds have rallied quite a bit since then, so it's less obvious. But I still think bonds and cash tend to be the answer. But also those unconventional protections that I mentioned earlier can be really useful. So volatility call options or equity put options, those sort of things.
Yeah, no, makes sense. And actually, speaking about cash, and I guess one of the silver linings about higher interest rates is that, after years of just, having your cash sit in a bank account and lose real value, you can actually make a nice, decent return on cash these days. But how does that raise the bar in terms of investing in stocks and bonds? If I in the US can make 5%, yield on my cash, how does that affect or raise the bar when it comes to investing in stocks and bonds? And does that kind of impact your asset allocation? Janet, maybe we can start off with you. Does that impact your asset allocation at your firm?
Well, it definitely raises the bar, because the questions we often get from clients is, why invest when cash already give you 5%? So I think I agree with what Duncan is saying. So we're not completely dismissing the recession risk. So I think bonds, we currently have a preference on bonds. So we do think that in that recession scenario, bonds would, generate good returns. It should outperform cash. But also, actually, in the soft landing scenario, bond yields, I think, would also fall, because in that scenario, inflation falls and growth falls as well. So I think we have to understand that interest rates are likely to come down. It wouldn't stay at current level. It wouldn't probably go back to the zero interest rate era, but it is very likely to come down. I think that's the important view. So in that scenario, bonds would outperform cash. And also, we just have to explain to clients that equities, historically still is likely to generate better return compared to cash. So I think it's just a bit more explaining to do to clients that cash rates is very unlikely to stay at current levels.
Makes sense. And Duncan?
Sorry, I'm adjusting my phone here as I'm on the wrong camera. Yeah, I think, look, one of the famous sort of phrases of the zero interest rate era was TINA. There is no alternative. And basically, as Janet said, there is now an alternative. It's as simple as that. And depending on sort of, who your clients are, I sort of pose the question, why take risk if you don't have to? It's, simple as that.
Yeah, I fully get that point. So in terms of, okay, you both touched on bonds being, a good hedge in a recession kind of environment. To play devil's advocate, I mean, I don't disapprove that. I mean, I also think bonds are a really good hedge against a recession. But just one of the growing bear arguments, I guess, against bonds is that, especially government bonds, is that the supply is set to increase a lot next year as budget deficits kind of swell all over the developed world. Governments running big deficits and having to borrow a lot and issue a lot of government bonds. What's your view on that, and how much is the supply side of things affecting the bond market and bond yields at the moment? Duncan, perhaps you can kick us off.
Yeah, it's become a really big topic in the last few months. I've really noticed the uptick in investor interest in this as bond yields started to go up, and basically the US budget maths doesn't work anymore. The cost of just paying the interest on Western government's debt is now sort of the second or third biggest expense behind social security, healthcare, and then maybe defense, education, plus interest. Is scary. So is US debt sustainability a problem? Yes. Do Western governments have sort of fiscal dysentery or fiscal incontinence? Absolutely. Some people would say with good reason. They're tackling a lot of big society issues. Janet mentioned some of them earlier: climate change, the energy transition, the reshoring, strengthening, retooling supply chains, so we're less reliant on on some of the bad actors in the world, wealth inequality, aging populations, 2 wars going on in Ukraine and the Middle East. There's a lot of things that either require or deserve money being spent on them, and the tax burden is already high. So are the government going to have to borrow more money? Yeah, almost certainly. Deficits forever. Who's going to buy them is another big issue. For many years, we relied upon the Chinese to buy US treasuries, or the Middle East to recycle petroleum proceeds into treasuries. They've both turned sellers. They're buyers of gold or other assets these days. And of course, the Federal Reserve itself, global central banks, were buyers of bonds for the last decade through quantitative easing. That's now become quantitative tightening, which basically means they've become a seller rather than a buyer. So there is undoubtedly a supply-demand mismatch, which is one of the reasons why bonds have been so bad over the last few years, I would say. Sorry, I don't know if Janet has anything to sort of add to that.
I agree with your points. I absolutely agree with your points. I think it will be a lingering concern in the background. I think that's why we are not actually very keen to add duration, as in to invest in the very long end of the curve, because I think they're really sensitive to interest rate increases and the structural aspects of the budget situation and the supply issues that Duncan has mentioned. So basically, we have a preference on bonds, but it's more the lower duration, because you already get actually pretty decent yields. You don't actually need to go too long the curve to get yourself exposed to this risk.
But can I just add one thing? The depending on whether you hang out on Twitter or Zero Hedge or whatever, the US government isn't going to default on its debt. That's not going to happen. They have a printing press, famously, that they use liberally whenever there's a crisis. So they can always print money to pay off the debt. However, that is inflationary. So you will definitely get paid back your $100 that you lent them, but your $100 might not buy you what $100 buys you today.
So at what point does investor confidence kind of fade away? You already had 2 credit rating agencies that downgraded the US. The third is kind of hinting that they will. And to your point, Duncan, if they can keep on printing money, sure, but it's inflationary, and you keep on getting these debt ceiling crises and all the drama, at what point do investors lose confidence and say, you know what, we're not going to invest in treasuries anymore?
Janet, would you like to answer that?
This will be our final question of this session, I promise.
Yeah, as you mentioned, there has been a number of issues like the debt ceiling crisis and potential shutdown of U.S. government, the chaos in the Congress. But every time it eventually gets resolved. So I'm of the view that there is not a lot of true safe havens around actually. So I think investors will still buy the treasury when they need it. I think, of course, the budget situation will be under scrutiny. That's why I think there will be talks, jawboning about improving the situation, trying to address that. But I don't think investors will completely lose confidence on U.S. treasuries, which is the last remaining true safe haven.
And if they do, we're all in a lot of trouble. that's the most serious crisis.
Well, on that very gloomy note, Tina rears its head. No, of course not. Tina rears its head again. There is no alternative to treasuries as a safe haven asset, for now at least. I'm afraid we are out of time, but thank you so much. That was an absolutely brilliant discussion. Thank you to my fantastic guests, Duncan and Janet, and for sharing their brilliant insights. Thank you all for tuning in as well. I hope you enjoyed it and you can take something away from the session. Don't leave just yet, because we have a session, which is the last session of the day coming up, which is called How AI is Changing the Way Investors Discover Opportunities, featuring the CEO of Prospero.ai, the founder and CEO of InvestAlert.ai, and the financial analyst and global content editor at IG. And that starts at 6:30 GMT, so in roughly 13 minutes, give or take. Janet and Duncan, thank you so much once again.
Thanks for having us.
Thanks for having us. Yeah.
And thank you all for tuning in, and see you at the next session. Have a great day. Bye-bye.